Brief this evening. For those of you who haven't been before, we are a free public library. There are 2 seats at the front. You don't have to stand. There's a couple left. We've never really had a night like this at the Library of Mistakes before. A couple of announcements. One, we have something new for Christmas. We were selling, this is a free public library, open 9 to 5. It doesn't cost you anything, but there is now a premium membership which will give you access whenever you like, and the ability to borrow books and other goodies as well, and we'll launch that in the next 2 weeks. And of course, anybody who buys a membership is supporting the work of the library here tonight and the work of making this available free to those who want to use it free of charge. So I hope some of you will sign up for that. I've only got one job tonight, which is to introduce my friend and a friend of the library. But first, just want to personally thank Tom for coming all this way, agreeing to speak some time out of what is an exceptionally busy schedule. We've had some of the greatest investors in the world here over the last couple of years, and now we add to that list with some panache. Now, friend of mine, friend of the library, I don't do this bit because I know nothing about individual securities, Tom, and everybody in this room knows that. So now we have an expert, Peter Hollis.
Thank you. Can I... Warmed up the crowd nicely. That looks like it's promising. Can you hear me at the back? Is my... well, good evening, everybody. Welcome to the library, which is, of course, Russell's brainchild. I think it's a marvellous facility for anybody who's interested in financial history, decision-making, human behaviour. And many of you have been here before, so welcome back. And for those of you who are here for the first time, I hope it's not your last time. My name is Peter Hollis. Tonight I'm going to be on stage with Tom Gayner. And after I've chatted with him, I'm going to open it up to you, the audience, to ask him questions. Tom is the chief executive of Markel, an American insurance group based in Richmond, Virginia. You may not have heard of Markel before, but I'm going to suggest that there are 3 reasons why you might want to learn more about it. First, Markel has been uncommonly successful. Since Tom joined the company in December 1990, Markel's share price and its net asset value per share have both increased by over 140 times. That is the equivalent of growing by 15% per annum for 35 years. The second reason for interest is that Markel has a very distinct corporate culture and credo. Tom will be talking about that tomorrow, amongst other aspects of the greater Markel Group in Edinburgh, to investors, friends, and other interested parties. If you are interested, I suggest you contact Caroline Paul of Markel, who is going to stand up and identify herself after tonight's talk to Caroline after tonight's talk. But tonight, we are not here to discuss Tom's role as the chief executive of Markel Group. Tonight, we are here to discuss Tom's other longer-standing role as Markel's chief investor. And this is really the third reason why I think Markel may be of interest to you. Markel is an insurance group, but it has... Good evening. It has an unusual emphasis on the importance it places in equity stock picking. Today, Markel's quoted equity portfolio is worth $13 billion. And Tom has managed Markel's equity portfolio since he joined the company. For those 35 years, Markel's equity portfolio has returned almost 13% per annum. To put that in context, that is 1.5% per annum better than the American stock market, and it is 2.5% per annum better than global equities. So a critical component of Markel's overall corporate success has been Tom's stellar stock picking. So with that said, I'm just going to ask you to please give a warm welcome to Tom Gayner.
Thank you. Delighted to be here.
Great. Tom, December 1990 is actually an awful long time ago. Are you able to cast your mind back and help us out with what you were thinking at the time and what maybe attracted you to Markel?
Well, indeed so. And I know one of the cultural features of being a Scotsman is to be brief. So I hope you will indulge me that I have some longer stories to tell, and that's one of them. But before I even begin starting to tell that long story, thank you, Russell, for the idea behind the facility and the warm welcome. And as he said, you've had some of the world's great investors here. Well, tonight would not be one of those nights. And I was wondering, and I spoke with Caroline, and let me introduce my colleague Caroline Paul and Tyler Brown. Please stand and recognize. They work with me in Richmond. And Henry Gardner, who is in London with Markel, is here visiting. So Caroline's been, it seems you've been there forever, but it's been a year or so, and I mean that in the most positive way. So I was trying to decide how much to speak and how open to be, and some boldness. And Peter has been sort of hyping this, and Russell said great investors and whatnot. So I know there's some wonderful investors here who know a lot of characters through the financial world. By show of hands, does anybody know who Lee Cooperman is in New York? So good. I'm glad some people know who Lee Cooperman is. And I hope you will accept my apology in advance for telling you a story that Lee Cooperman told. So Lee Cooperman is from Brooklyn. He is one of the world's great investors, done spectacularly well. And one time he was introduced, and I said, that's the best joke I've ever heard. So Lee Cooperman, in his New York Jewish Brooklyn way, had been sort of puffed up in the introduction. And he said, well, before you get too far carried away, this reminds me of the Scottish professor of medicine who was lecturing his class on human anatomy at one point. And he posed the question. He said, under what conditions of proper stimulation, what organ will reach 4 times its normal size? And he looked around a bit, and nobody was doing anything. And so he finally, as a professor could do, called on somebody and said, Miss McGillivray. And she said, oh, Professor, I cannot say. And he says, the answer is the pupil of the human eye. Now, Miss McGillivray, I have 3 things to say to you. 1, you had not been doing your homework. 2, you have a dirty mind. And 3, you're doomed to a life of unfulfilled expectations. So Caroline encouraged me to go ahead and be bold, and I did want to at least blame Lee Cooperman a little bit before we went too far down that path. But I do very much enjoy being here, and I hope your expectations are not too high. I have been to Edinburgh and Scotland, I think about 8 or 10 times. And as we were walking over here, you talked about how sort of when you were just starting out, the idea of going to Boston, Massachusetts, and becoming an investor there was something that in your youthful passions might have been a goal of yours. I will tell you, as an American, as someone who lives in Virginia, I have been to Edinburgh and Scotland more times professionally than I've been to Boston. Since we're in the library of mistakes and the spirit of sort of inquiry and trying to always wonder why, what would have driven that, what I would say is that the culture of investing that has historically existed in this city is unique in the global stage. It is singular, and it is very different than Boston. And frankly, from the way I think about things, I remember the very first time I heard about Edinburgh and the investing culture. I happened to be at a conference outside of Burlington, Vermont. And I don't know the gentleman's name, I don't know what firm he was. This was 91 or 92 or something like that. And in the context of a 2 or 3 day conference, this guy got up and he showed pictures of sheep, and he spoke softly and quietly and without a hurry, and he talked about his investing career here and his way of thinking about things, and that just immediately resonated with me. And then someone was asking me where you and I first met, and I don't remember when that was, and whether it was here, whether it was in Omaha or Richmond, I don't remember, but it's been roughly 30 years, plus or minus a year or two. So the idea and the culture of long-term ownership that is centered in this town, that has just always resonated with me. So I started coming and have come several times since. I thought this particular time when this trip was coming together, the idea that I would come in November was meant to be an act of sincerity because the weather should be miserable in Edinburgh, and I just wanted to show that I wasn't just here to play golf. I was here for serious business. But the weather is such that we should have scheduled some golf today. So again, thank you very much for the warm introduction and being here, and the culture which you represent, because our company fits that as well, and it is the way we think about things and do things. So we're not all the same, but there's resonance and rhyme. So, starting to answer your question, 1990.
You've got a good memory.
Thank you.
You remember it? Good.
In 1984, I was working had two hats. I worked for a firm, and someone was telling me the story when we came over, something that got started in 1863 here. What firm got started in 1863 or whatever, it doesn't matter. The firm in Richmond that I was working for at that time started in 1863 as well. And it was called Davenport and Company of Virginia. I had two hats. I was an analyst who covered companies and wrote reports, research for the firm as well. And I was a broker who had individual clients. And in 1984, I was reading Fortune magazine just randomly, and I read Carol Loomis's article about Buffett at that time. And the scales fell from my eyes. It just made epic common sense in every way that you could imagine. And I remember going into the head of the department and asking him, hey Joe, have you ever heard of this guy Warren Buffett? And he said, he's sort of a crusty fellow. And he threw me out. He says, it's Buffett, you idiot. But I saw that. And then in 1986, Markel went public. Now, Markel was headquartered in Richmond, Virginia. I had never heard of it, didn't know a thing about it, even though I lived in Richmond for a couple of years. And it was this specialty insurance company. And back in 1986, in studying financial history, and by the way, I watched one of your talks, and you talked about the value of reading financial history in order to try to get a fulsome contextualized picture of what's going on in ways that you cannot do through spreadsheets or mathematical analysis, and you couldn't be more right about that. But so the idea of Markel, they were the specialty insurance company, and that was a time when interest rates were just coming off their extraordinarily, once in a lifetime peaks of 18, 17, 16%, and they were starting to come down, but they're still very high. So in insurance, the idea of a combined ratio, which means for every dollar coming in, how much is going back out in the forms of expenses of running the company and claims. So for every dollar that came in, it was a relatively common practice that $1.03, $1.04, $1.08 would go out, but that was fine because you were holding the money, the premiums, and you would earn so much just from interest income that you could have not wonderful returns on capital, but reasonable returns on capital from doing so. Markel had the history, and we can talk more about this in another question. They do things other people won't do. If I'm at a cocktail party and somebody asks, what kind of insurance do you do, which happens in cocktail parties all the time, I say, well, if there's a form of insurance that you can get easily and quickly, we probably don't do that. We do stuff that somebody says, oh no, or how could I get coverage for that? So different things. So Steve Markel, who's the gentleman that hired me, who's third generation member of the Markel family, he would say, because of the things that we do, we are bringing expertise and intellectual capital, not just financial capital, to the table. So we should be paid for that. We're doing something of value in that way. So they had the discipline, even when other insurance companies would happily operate at 103, 104, whatnot. It had to be 99 or better, which meant they were profitable from an insurance point of view. And he was willing to take that penny or two of underwriting profits and invest it longer term, i.e. in equity securities at the time. Well, that was 1986. That was a dot being connected in my mind immediately that this company I'd never heard of, but I was assigned as the analyst to go cover them. I saw they wanted to make an underwriting profit, and they were willing to invest those underwriting profits longer term. That is exactly the formula by which Buffett built Berkshire. So here it was. So recommended the company, recommended the stock. I actually bought, it's the only time in my life I've ever bought shares on an IPO. I bought 100 shares of Markel at $8 a share, which I still own, those shares, which were $2,000 at some point earlier today. We'll see where the day ends. So 86 through 90, I became a friend of Steve's. He became a client, started doing business together. And then February 14th, Valentine's Day, 1990, Drexel Burnham went bankrupt. And for those of you who are financial historians or of the age when you remember Drexel Burnham and what they did, Michael Milken, that was the junk bond era and the financing of the first wave. These days they've gentrified and they call it private equity. Those days they called them LBOs. So that he was the king of that sort of thing. So they went bankrupt February 1990, and the junk bond market really collapsed that day. So the fellow who I worked with, and the two of us were partners, and we would talk all day long. We just said, and we were equity guys, we said if we were ever going to buy a bond, today is the day to do it. And in fact, we didn't even call them bonds. We called them SIDS, which was an acronym that stood for Stocks in Drag. So in our very unsophisticated way of thinking about things, we thought, so of the companies that are out there that have been taken over in these LBOs, which one is probably the most creditworthy? And we decided at that point in time it was RJR Nabisco. And so I'm an accountant by training, worked for Coopers & Lybrand, and now PricewaterhouseCoopers, and just looked at the capital stack and what was going on, and noticed that there were some zero coupon bonds that were trading at that point at about 30 cents on the dollar. Our rough estimate, swag, was in a bankruptcy where we thought they were worth 70. So, 50 cents on the dollar kind of thing, but trading at 30 cents. And they had this provision that in 1994, 4 years later, they had to be refinanced at a rate that they traded at par, which is sort of the higher the rate, the more credit concerns one would have. So it was just this really weird, tricky security. But I thought it was the fulcrum security to the whole deal. So that was the one that I wanted to buy. So the tax laws in the U.S. had just changed. There was this thing called TEFRA, which meant that if you bought, and by the way, nothing is new. That's the whole point of Library of Mistakes. You should study things because nothing is new. And given elections and concerns and government circumstances, the idea of tax laws changing, i.e. tax rates going up, I don't think that's a new phenomenon. So we're dealing with that. So that was an episode in an era where that was taking place. So in this particular tax law, if you bought a bond at a deep discount, you had to accrete the accrued interest income, even though you didn't have cash to do it. So you would have a tax liability if you bought something like that. So most people wouldn't buy them because you didn't know about the credit, and you did have to take money out of your pocket to pay the tax liability along the way. So, all right, that's a dead end. You can't just call people and start selling them that. For tax-deferred retirement accounts and things like that, you would be sort of at the edge of your fiduciary duty, and these were gamey securities. But I just happened to know that Steve Markel, along with his cousins, had borrowed money. And this is part of the culture of why Markel is the way it is. They had borrowed the money to buy their equity stakes from the second generation. And they had interest expense, which was non-deductible, because the way the tax law had changed, you could only deduct interest expense to the extent you had interest income. So again, this is just one of these dots connecting in my mind. I called Steve up, and I said, you're the one person in the world who this makes sense for, because you can accept the accreted interest income without a tax cost from doing so, and I think it's a good investor. It's a good investment. So he agreed to do it. That was February 14th. By December, 10 months later, those bonds were paid off at par because they were indeed the fulcrum security. RJR could not operate without refinancing that. So that might have been December 1st. I think by December 2nd, I was working at Markel.
So Markel has sometimes been called a mini Berkshire after Buffett's holding company, Berkshire Hathaway. I mean, is that an irritation to you, or is it a conscious imitation of the Berkshire model?
Again, saluting the spirit of the library of mistakes. In addition to learning from mistakes, you should learn from things that go well. There is that side of the coin as well. Sometimes these things work. And I can't think of a better example of a spectacular, well-run company that would be much better than what Berkshire's been over the last 50 years. So I've consciously studied that and tried to learn from the things that go well as things that go poorly. And again, this is a 25-year-old story, but one time some analyst was coming through and they were looking at Markel and they were doing their due diligence and asking all sorts of questions. And at the end of the day, the fellow said, the problem with you guys is you're trying to be just like Berkshire. And I said, who would you rather us be like? I'm flattered by that question and the comparison, not offended by it at all. Now, sometimes people, I don't like the word clone. That despite being the land of Dolly the sheep, if I remember that correctly, that implies not thinking and not being thoughtful. And I think the things that we try to learn from Berkshire do involve thought and things that are appropriate and perhaps not appropriate. And it stuns me. I think the more interesting question is, why are there so few people who do adopt that model and try to do what he does? That's a more interesting question to me.
Do you want to answer that question?
If you're asking, yeah, sure. I think there's a variety of reasons to it. One of the things that I observe, and I've gone to the Berkshire meeting for 35 years in a row, and again, just try to be there. It stuns me each and every year, and Buffett was 62 the first year that I went, and he's 95, and inevitably there would be somebody who was, I'm guessing, 22 or maybe 25, but certainly in their 20s. And the guise of asking Buffett a question, in effect criticizing him and telling him what he's doing wrong and how he is not keeping up or got something wrong or so on and so forth. So I say, I think one of my professional goals is to be second-guessed like Warren Buffett. The guy gets second-guessed every single year that I've ever gone to that meeting about what he's gotten wrong or missed or been passed by. But look at that record. It certainly seems pretty good. So for some reason, there just seems to be this human nature revulsion to the simplicity, the deep simplicity that it has, number one. Number two, and again, I'm sure there are many books on these shelves that would be helpful in the sensation of this, is when you are doing something different, and he has, and it's singular, you are not protected by the crowd. You are not operating with the comfort of psychological safety by not, if you're wrong about something, and you can say, well, we were all wrong, that absolves you of personal responsibility. When you take a position, and it is not a consensus position, and you're doing it in a singular way, in a way that people in general are not doing it, you've exposed yourself to career risk, if nothing else, isolation. It's like the comedian one time was talking about Copernicus, and Copernicus, deciding that the sun is the center of the universe as opposed to Earth, and him just sort of imagining the other people around Copernicus in his town thinking, well, yeah, you might be right, but do you think Copernicus got invited to any more cocktail parties? To be different requires effort, and it is effort that none of us as human beings can endure completely. The idea that we need social relationships and personal relationships and friendships, I don't care how introverted you are, you need some of it, different doses. But I think those are the two fundamental things. The acceptance of personal responsibility and being different are psychologically incredibly hard. So you look at what Berkshire's done, you look at what Buffett's done, it's kind of easy to say. It's simple to say. It's not a complicated formula, but it is way, 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 way harder to do than it is to say or articulate.
Yeah, simple but not easy,
Right.
Is obviously. What about Warren and his partner Charlie Munger as role models? Would you regard them as role models in your life, and what are the big lessons that you've...
Absolutely, and I can remember going there the very first meeting that I went to. So I guess I was 29, and I had small children at the time, and I was there, and I went by myself, and I was laughing. I was having such a good time. So I remember calling my wife, and I said, "You need to come to this with me. This would be so much fun for you to see." And obviously, she was a working mom with 3 kids, and she said, "What are you, nuts?" It's pretty difficult to extract Susan from her schedule, but I said, because these guys are hilarious. It's like seeing Mark Twain when he's still alive. And don't wait, because they are old. And at that point, Buffett was younger than I am right now. So the humor, the charm, the fun, the joy, the joie de vivre. So fortunately, this would have been 2007, I was recruited and invited to join the board of the Washington Post Company. And that was a great highlight moment in my life. I absolutely wanted to. There's all kinds of stories I could tell about that. And Buffett was on the board at that particular point. And I can remember the very first meeting. So we have some meetings, and then Don Graham had dinner in his house for just the board members, and this was just spectacular. And Buffett's sitting right next to me at the table. And I did start life as an accountant, so I was sort of slotted to be on the audit committee and the chairman of the audit committee. And Buffett puts his arm around me and says, "That's our version of hazing." So the dinner takes place and the meeting and whatnot. And by this time, we'll call it 9:30 or 10 o'clock at night. And I'm sitting with my friend Chris Davis, who's one of my great friends. And Warren said, "Come on back to the room if you would, because there's some stuff I want to ask you guys about." So we go to his room, and it's Chris and myself and Warren there. So, Warren Buffett is my hero. He is my hero. And I'm sitting here just talking to him in his hotel room. And he just goes on and on and on and on. Question this, question that, da, da, da. And finally, about 12:30 at night, I'm sort of having toothpicks to open my eyes. And I said, "Warren, this is the coolest thing I've ever been involved in my life, but I'm exhausted. I have to go to bed." So I excused myself. But at that point, he was, late 70s, something like that. So his energy level, and here's one of the things that's very underappreciated about Buffett. That guy's an athlete. He is an athlete. The physical stamina it takes to work at the pace and frenzy and energy level that he works at, that I've observed firsthand for years and years and years, people underestimate how much athleticism is involved in that, along with the mind. Charlie's a bit calmer and doesn't fidget as much as what Buffett did, but nonetheless, yeah, absolutely role models.
And Charlie as well, or is Warren just on a different scale?
Charlie would even admit that Warren's on a different scale in that energy level and intensity, but he was extraordinarily well served by his partnership with Charlie. Because one of the things, and again, and I know that our focus is on investing tonight as opposed to the management and executive role, but I think they are inextricably linked in many dimensions. And in my role as a manager, oftentimes if I observe or see somebody who might be struggling a little bit and I'm trying to help them, among the things I will ask them is I will say, who do you have in your life that can tell you you're wrong and that you continue to respect? And I would say in the first tier of that for myself, my partner Mike Heaton, who's the COO of Markel, one time when I first sort of drafted him down the hall to help me on a project, and 20 years later he's now my number 2 and COO of the company and has been for quite some time. At one point he asked me, "So why did you ask me to help you with that?" And I'd known him a bit, and I said, "Well, Mike, you have this uncanny ability to tell me that I have my head up my ass, but I still like you." And that's an unusual skill to be able to do that. So Mike plays that very important role in my life. My wife Susan does as well. And in addition to being spouse and partner, she is the CEO of one of our businesses, so has professional chops as well. And she's extraordinarily helpful. And Chris Davis, who's just been a close personal friend for 35 years, that has that kind of relationship. So I hope and pray for you that if someone asked you that question, you'd be able to have at least 2 or 3 names. Not 20, not 12, maybe 5 or 6, more than 1. So for me, that number is 3. But that notion is what Charlie did for Warren. Because one of the things that Warren would be challenged by, and we all have this, and again, this ties to the notion of mistakes, is oftentimes, and I'll tell this story. So one time there was a company that came up and it was a possible acquisition target, and Steve Markel sent me out to go visit this company and visit the CEO and take the first pass at looking at it for whether it was something Markel should think about buying or not. So I go out and I visit the guy and I come back and Steve said, well, how was it? And I said, if that guy is half as smart as he thinks he is, that's the smartest person I've ever met in my life. And he was smart. We did not do that deal because one of my underwriting sensations was he's not as smart as what he thinks he is, and that's dangerous. So people who are very, very intelligent, and generally speaking, the IQ levels of people in the investment business who've been there for a little while, they're pretty high. It's an above average IQ profession. But you need to recognize that you don't know everything, and you're not as smart as what you think you are, and you need partners who can counsel and help you and tell you that, but do it in such a way that you will listen to them tomorrow and the next day. Because it's very hard not to take those kinds of things personally. Mm-hmm. We're human beings, and we do take them personally, but can you be mature enough to be grateful for constructive criticism as opposed to being offended by it?
How would you describe then your investment approach, Tom? Is it just a copycat of Warren? Would that be a short answer?
Well, copycat seems dangerously close to cloning. I don't know whether those IQ points on display there was designed to trick me with that question or not, but I'll
Have you got a thoughtful answer?
Well, thoughtful is exactly the right word. So again, and you had asked me earlier about the size of our staff, and that it's, for 17 years it was just me, and Steve is a part of it, but he was doing other things as well. And one of the responses I would make, people say, well, how do you do that? I said, well, look at a list of our shareholders. And again, this is why I've been to Edinburgh a number of times in my life. If you look at the list of our top 20 shareholders, and by the way, this is something perhaps worth talking about because it is different in today's world than what it was 20 years ago. And who knows what the cyclicality and the way that might turn is. But 20 years ago, if you had printed out a list of our top 20 shareholders, I would have told you that I know 14 of them. 4 of them are computers, and 2 of them I don't know yet, but I will. So there were relationships that were formed with our investors, many of whom were very good investors. And I would always tell them, I said, we all file our holdings publicly with some time lag, but it's public what we all do. And I say, here's the ironic thing. You are smarter than I am, but I am managing money for you in the context of the Markel investment portfolio. So if you see me doing something that's stupid, tell me. I'll listen. And if there's something you think I ought to do that I'm not doing, tell me, and I'll listen. And it is actually in your best interest to do that. And I'm not talking about insider trading, because if you're an investment professional and you have a good idea, you should do it for your clients first. Absolutely. But after you've established your position and bought it and done everything that's your fiduciary duty to do, your best interest is to tell me about it, because if I agree with it and add it, it's actually adding to the weight of that idea in your portfolio through the indirect ownership of Markel. So those kinds of relationships have been very important over the years to have idea flow and conversation. Now, what's different about that today, and perhaps we might be at the apex of that, and we can talk about this because I think this is an important topic, of those top 20 holders, I know 7, and 9 of them are computers. And then I'm never really going to develop that close a relationship with. And 4 are people I don't know yet, but that I hope to know in the fullness of time.
Okay, so your style is, I mean, you're a buy and hold man. Your turnover is less than 5% a year.
Between 5 and 10, probably, yeah.
And that is a inbred lesson from your grandmother.
Well, a couple points of that. One, and again, Buffett's an interesting role model and example here. He talks a lot about paying taxes and Berkshire's tax bill and whatnot, but he doesn't like to pay them. So, you know, if you and who does? And again, the reasons I've been to Scotland are because either I connected to this investment culture, or I'm drinking whiskey, or I'm playing golf. And there's a lot of interconnection between all of those things. And if you think about the whiskey business and the tax collection mechanism of what's involved in that, and the desire of the Scots not to pay taxes if they don't have to. I mean, there's some heritage of that, which, by the way, when it came to America, and there's a great book called Born Fighting by James Webb, it's the Scots-Irish discussion of in Virginia and whatnot. So moonshining in the U.S. Is a direct lineal descendant of the heritage, both of the distillation techniques and the desire not to pay taxes on it. So it has not been our greatest investment recently, but it is an investment we've had for some time, and I think it's a worthy investment. Diageo. Well, one of Diageo's lead products is Johnny Walker Scotch. And I've been to the Cardew Distillery and sat in Johnny Walker's library and whatnot. And a bottle of Johnny Walker Red, not black, but red, says since 1820 on it. And you think about AI and all the things that have changed. Well, think of all the things that have changed since 1820. I don't know, railroads, cars, airplanes, telephones, harnessing electricity, and yet it's still a relevant brand. And Johnny Walker himself was a pharmacist in Glasgow, I believe, and apparently he was an honorable person. So if you're making bootleg whiskey, sometimes that's not very good. Sometimes you can go blind by drinking that. Johnny Walker was trusted because he was honorable. So you had the sense that you were buying a quality product that would not make you go blind. And that was the basis for a brand that is still of value since 1820. Well, if you have something that can endure those sorts of technological changes that have happened and continue to happen, and it's based on trust, mutual, people win. I mean, they win by selling it at a fair price where they make a profit, and you win because you get a good whiskey at a fair price and you don't go blind. So that's a win-win deal. And to the extent you can buy and hold things like that, you defer the tax liability. So, for instance, when you look at Markel's numbers right now, as of our most recent 10Q, we were closed in on an equity portfolio of $13 billion. $13 billion. The cost of which is about $4 billion. So almost $9 billion of unrealized gain on that portfolio at a 25%-ish tax rate that would prevail in the U.S. right now. That's over $2 billion of, in essence, zero-cost financing on our balance sheet that we get to invest and earn the gross return, but only have net sort of $7 billion of capital against that, now because of the deferred tax liability. So if you can find things like that, it makes great sense to do. Now, Peter made reference to my grandmother, and I have told this story many times. So my grandmother was a very interesting woman. She went to a school called Swarthmore, which is a Quaker school outside of Philadelphia, in the 1920s. And not a whole lot of women were going to university in the 1920s, but she did. And she became a school teacher. She spent her very first paycheck on a fur coat. Just trying to paint you some picture of the eclectic nature of my grandmother. In her 80s, she got a burn on her leg from riding on the back of someone's motorcycle. So let's get the picture here. My grandfather died when she would have been in her mid-60s or so. And despite the fact that she was educated, a working woman, eclectic interest, a voracious reader, read the Wall Street Journal, watched a TV show called Wall Street Week with Louis Rukeyser, and as a unsuccessful person trying to get a date on Friday night, there was more than one Friday night when I would sit with my grandmother and we would watch that TV show. Well, so all this action and all this thought, and yet when my grandfather died, she was a widow who never made another decision. She lived in the same house. His suits hung in the closet. His shoes were on the floor. And in that era, and again, it ties to indexing and some of the other stuff we've been talking about. I mean, he might have had 12 stocks, because he was a small-town businessman, and small-town business people did things like that, and they would go to the diner and they would drink coffee and they would talk to their buddies about what they owned and whatnot. It was part of their life. So she owned those 12 stocks for the rest of her life. Now, fortunately, among the 12, two of them, one was Lockheed Martin, and the other, and it does kill me because, I'm on the Coke board, one of them was Pepsi. But those two did so well, it kept my grandmother in a pleasant upper middle class lifestyle for the rest of her life. And when she died, actually, I received an inheritance of $25,000. It's the only inheritance I ever received. It was from my grandmother, $25,000. At that time, Markel stock was trading for $25 a share. And I bought 1,000 shares of Markel with that, which I still hold on to today, which is worth a bit more than that. So, yes, I've had some vivid examples. And again, connect you back, that first guy from Edinburgh who I encountered in Virgins, Vermont, told stories like that, which resonated with me.
Okay, Tom, we're in the library of mistakes. Okay, Bill Gates says that success is a lousy teacher. Yeah, and that's really the foundational insight for this institution.
Right.
Talk us through some of your mistakes and what you've learned from them.
I'd be happy to do so. Maybe that's why I was giving such long answers earlier. Trying to crowd out the time because Peter had prepped a little bit, and through Caroline sent some backdoor messages about mistakes, and I suggested one or two stories, and I heard, well, what about another one? What about another one? What about another one? And it reminds me of the time that when Susan, we got married while we were in school, and that was 82 and 83. And interest rates were 18, 20% at the time. And she was a chemical engineer. And it was a miserable job market. And I was an accountant. Unfortunately, the job market was better, so I got a job easily. Susan struggled a bit to get her first job. And one of her first interviews, before she learned how to interview a little bit better, was Exxon. And it was the classic. And women were not common as chemical engineers at that time. And Susan's a pretty introverted, shy woman to begin with. So the classic, tell me about your strengths, tell me about your weaknesses and whatnot. So he gets the weakness, and she knew that question was coming, so she had an answer. And the guy says, well, what about another one? And she's trying to be compliant, so she came up with another weakness. And the guy said, well, what about another one? And so just trying to answer the question here. Came up with another one. He said, well, what about another one? And she finally said, I think that's about it. So I'm prepared for a few of them, but there will come a time when I'll say that's about it. The first one, and mistakes come in categories. They could be mistakes of omission or mistakes of commission. And mistakes of commission are things that you do that you shouldn't have done. And generally speaking, those mistakes are a lot smaller and easier to recover from, and just are not as big a deal as mistakes of omission. It's like the comedian who talked about, this was a comedian who became very famous, very rich, and got himself in all kinds of drug problems and everything. He says, I was so much better off when I was broke because I could only get $20 messed up. And there's a sort of a natural limits to only have $20. And mistakes of commission are like that because there's a feedback loop that says you were wrong, and you can learn from them. So those are tiny. Mistakes of omission are way worse, way worse. And there's multiple levels as to why they're worse. Because a mistake of omission is something you didn't do, so you don't have to tell anybody. And if you don't tell anybody, and you don't talk about mistakes of omission, the person you're really not going to tell about it is yourself. And that takes away your ability to learn. So I'll answer the question. The biggest financial mistake I ever made in my entire life was in 1984, reading that article about Berkshire and going into the department and getting thrown out and going out and looking it up. The cutting edge technology in 1984, pre-Bloomberg terminals and Yahoo Finance or whatever you use, was something called the S&P tear sheets. They were little odd sheets of paper. And I looked at the S&P tear sheet for Berkshire, and I'm an accountant by training. I'm not an idiot. Those numbers were great. But I thought, no stock could possibly be worth that much. So I didn't buy any. And I didn't.
$500?
Something like that. Yeah. It's a little painful to remember, but.
Today it's 740,000?
Exactly. Yes, yeah. So I didn't buy any. In 1990, when I joined Markel, that Steve twisted my arm. And that was the first thing we bought for the Markel investment portfolio. So it's worked out. But again, I'm still not making a mistake about that because I bought that Berkshire stake in 1990. Then until 97 or 98, I did not buy any more of it. Was keeping track of it, monitoring, seeing it, year after year after year. And what happened was in the late 90s, that was .com 1.0. And from 90 through 96, I did great, white hot, got a lot of credibility, got the confidence of the Markel board to manage the money. But starting in the late 90s, my record started to diverge, and it really it was the biggest professional gap I'd ever had in my entire life. And because I couldn't pencil out numbers, having the ugly habit of still being an accountant and trying to have things add up, the only thing I could find that was sort of making sense to me was Berkshire. So I really ended up buying a slug of Berkshire in the late 90s, not because I was brilliant, but because by default, that's the only thing I could find to invest in. So that was a mistake of omission. I've made a lot more.
And that has been about 10 or 15% of the portfolio ever since.
Correct.
Yeah.
Right.
Why is Berkshire a painful mistake of omission and NVIDIA is not?
Well, I think the story remains to be told about NVIDIA. So I might be wrong. I might be completely wrong. I certainly have been wrong so far. Anybody keeping score of the ball game so far would say, you've missed it, and they may be right. I have spent my entire career, and you were very kind to point out that we've sort of done better than the S&P 500 for a long period of time. And I think all of us as professionals know that's pretty hard to do. So there would be some credibility that would come about that statement. I have never been a cool kid. I've never owned a hot stock, not once, ever. And I can recall all of them and being sort of on the outside with my nose pressed to the glass looking in. So if I go back to the 1990s, that particular era, when I first went in, America had a banking regime where, and my family, my Uncle Dick was the president of the local bank. There were thousands of local banks all around, and banks started consolidating and adding together. So owning bank stocks and having the next one that would be taken over was kind of the hot thing to do for a while. Then drug companies were the hot thing for a while. So Merck, I can't remember the name of the drug that they had, which was just the thing at that point, and it was known as Saint Merck. And then Pfizer came out with their
You can remember that drug name.
the Pfizer-riser, as it was known colloquially at the time. And I didn't own any of that. And then the dot-com era came. I have never owned any of them because my bias wiring and things that I really need to be conscious and keep myself from making a mistake on this is I get suspicious about the cool kids. I wasn't invited to the parties when I was a kid, so I feel like I should be careful as an adult. And sometimes, party seems like it should be phrased, you and your wallet are cordially invited to this particular event. It's a bias. So we will see. And if you look at the market cap of NVIDIA, I heard the other day, it is equal to the GDP of Germany now. And if you gave me the choice, what would you rather own, the entirety of Germany or NVIDIA? I'm going to go with Germany. I just am.
Let's take you back then to that period, 98, 99. If I can put some numbers on it, Markel's equity portfolio was flat over 2 years.
Or down.
And the S&P was up over 50%.
Correct.
Now, and you're a man in your, the first decade at Markel. Talk us through the social pain that you're suffering there, the FOMO, what is the difference between temporarily out of favor and wrong? How do you?
You don't know until hindsight. And the shortest statement I can make, and I can remember that time, I can remember saying this, I said, I am in a race between being right and being fired. Number one. Number two, Steve Markel exhibited one of the great feats of management and leadership that I've ever witnessed in that particular time. And here's what he did. So his office was right next to mine. And again, I started off that period with credibility because I'd had 6 or 7 really good years before that started. And every month, Steve's office was next to mine, so I'd talk to him all day, every day, and just normal, casual conversations. But we did have one formal monthly meeting where I would have the portfolio and, generally speaking, doing triage of some of the largest holdings. And we would talk about any developments, any new products, any new management sales, just fundamental things about some of the largest things we owned. Well, because I recognized that just the world seemed to be off its rocker and different, in addition to talking about the top 5 things that we owned, I would come in and I would talk about the top 5 things going on in the news that we didn't own. So the dot-com stuff that was going nuts. And talk about the same sort of thing, sales, earnings, or lack thereof, and management behaviors and all sorts of things. And Steve would listen, and at the end of every meeting for about 18 months when this was going on, he concluded the meeting by saying, I understand what you are doing and why you're doing it. And I understand what you are not doing it and why you're not doing it. See you next month. That's stunning. That's stunning. So to have clients like that, who you'd be able to have that kind of discussion, that kind of relationship with, it's singular. I mean, it just doesn't happen. So, and then the last thing I'll say, and again, it ties, I think, to some degree about some of the things I feel or sense today with the indexing and the carrying on. The last real bear market we had was 08 or 09. And, you know, in 20 with COVID, yeah, prices went down. But it was so short in its duration, and it was so external. It was not anything that you did wrong. You would not have a sense of personal responsibility about how you screwed up because the market, I mean, this worldwide pandemic happened. So what could you do about that? So it was really 08, 09, the last time we had a bear market of any size and duration. Well, I do see some gray hairs and some no hairs in the room, but do the math here. So that's 17, 18 years ago. If you're 20 or 25 and you lived through 08, 09, maybe you had a little trouble getting a job, but you're just starting out and you don't have that much skin in the game. You don't have that much to lose. If you're 30, well, maybe you own a house now and you're starting to accumulate a little bit, but not so much. If you're 40 and you have a mortgage and you have 3 kids in private school for which you're paying tuition and some bit of a nest egg, a bear market hurts. It hurts you in a visceral way that, again, to your point in the talk that you made, you can read everything you want, you can write everything down, you can put every number through that, but until you feel that, you don't know what it is. And the 08, 09 experience, given the time lag it's been, you have to be in your late 50s to have a visceral memory of that at this point. And think of how many people you deal with on a daily basis who are younger than 57. It grows every day.
Yeah, I think there are some things just have to be experienced,
Correct.
can't they? They can't be taught. I mean, Seth Klarman has another nice line, though, that, you know, in bull markets you learn bull market lessons, and in bear markets you learn bear market lessons, and 17 years of perhaps. But, I mean, James Joyce and mistakes are the portals of discovery. Tom, I mean, what are you doing differently today than you did in the 90s? Or what do you think differently or believe that now that you didn't then?
Oh,
Is that, mistakes have presumably triggered a lot of that reappraisal.
as Mike Heaton, who I cited earlier, my partner, he has an interesting phrase. He says, do you know what it feels like when you're making a mistake? It feels great. Because otherwise you wouldn't be doing it. So I live with the same amount of terror and paranoia in my mind today that, frankly, it's either a blessing or a curse. There's just a certain dosage of that. Like Andy Grove wrote that book, Only the Paranoid Survive. He's right about that. So you want the amount of paranoia that drives you to excellence and diligence and concern without tipping over into psychosis. So I'm just trying to keep that balance somewhat intact.
Okay, so it's 7:25, Tom. I think I need to open up the floor at some point here.
Lovely.
I've got 2 more questions, if I may. But in the 90s, Markel did outsource some of their investment management to Fairfax and Prem Watson. If you were to outsource again today, what traits would you seek in an investment, and particularly perhaps an equity one?
Well, let me give you some of the historical context for why that would have been the case. So Prem Fairfax, the original name of Fairfax was Markel of Canada. That was our Canadian office, which had some challenges in Prem's first acquisition was of that office. So that was a relationship that predated me being there, that he had managed some of that money. It was 95% fixed income money and maybe only about 5% equity. So just to give you the historical context of that. From time to time, we have made minor investments with some people that just sort of caught my fancy, and I thought I could learn something from them, and just to try to get inside the tent on somebody's thinking on a portfolio. By and large, that has not been spectacular for us. So 98, 99% of the money is indeed managed in-house and probably will continue to be so.
Okay. Was that my question? Well, but what traits would you, if you were going to do it, what would you see in
the arrogant thing to do would be somebody who thinks like me, and would have the same sort of disciplines and approaches and whatnot. That's a stupid answer as well as being arrogant, which arrogant answers always are, because what you should look for is something different. Somebody who's anybody know the movie Rocky? Remember the movie Rocky? Sylvester Stallone. It was one of the first movies my wife and I, when we were dating, ever went to. And there was this scene there where, Rocky proposes to Adrian, the girl. And Adrian says, why you want to marry me, Rocky? And he says, I got gaps, you got gaps, together we fill gaps. It's a beautiful answer, and it's absolutely true. So really what you should be looking for is someone who is different than you, but within the context of a discipline that can be helpful to you, that you can learn from. Because, for instance, I'm never going to own NVIDIA. I don't know how to own stocks like that. I'm terrified of owning a stock like that. Now, by the way, we happen to own 5 of the Magnificent 7 and have for a decade plus. So it's not as I'm completely stubborn and stupid about not owning things that have technological overlays to them. But
it's just Tesla and Palantir that you've got a bit of a problem with.
Those would be among the things that we don't own, yes. And that's a matter of public record, so it's not deniable. But yeah, what I would look for is someone who has just that spirit about them, and because of the Berkshire circles, the Omaha circles, the Markel circles, friends of friends, the conversations that you have by being in a setting like this, you can learn some things, and that's what I would be looking for.
Okay, last question then. The library of mistakes. We've talked about mistakes briefly. What about the library aspect? Are books important in your life?
Hugely, hugely, hugely. I'm a voracious reader. I grew up on 100 acres, and my sister was 18 years older than me. My brother was 14 years older than me. So it's essentially an only child kind of thing. So in that kind of circumstances, I can remember a set of encyclopedias and just reading the Encyclopedia Britannica. That was what I did as a kid for fun. And I love books, and I learned so much from books. I love the conversations that take place with people on account of books that you would share and learn from. And interestingly enough, and again, the amount of reading that's pretty well documented is diminishing in our society, and people's attention spans are lowering. And so that means either I'm a dinosaur or I'm developing an epic competitive advantage. It's one or the other. Yeah,
how about the Japanese author, Harry Murakami? One of his quotes is that if you don't read different things to other people, how can you possibly think differently to them? So maybe just reading is...
Agreed.
Anyway, on that point, Tom, I think I better open up to any questions from the floor. I'm sure people are itching for. Here's one from... Can you perhaps just say your name as well, and if you work anywhere?
Thanks, Tom. That was great. John Carnegie, and I suppose I may represent Bailey Gifford during working hours. When those 17 years that you were gone from a pretty young man into
a not so young man.
Well,
okay.
Thank you. How many stocks would you typically own? I'm kind of just wondering, what the breadth of your portfolio was, and did you think consciously about how many a single person could
Well, there's
could own?
two truthful, honest answers to that. One is the numerical number of stocks, and the second is some sense of weighted average to that. So, number of stocks that we would own at any given point in time, over 100. And I view sometimes these tiny positions, I call them library cards, where actually just owning a little tiny bit of something makes me think about it more than I otherwise would. But if you add up the bottom 40 of those holdings, they wouldn't amount to anything that would make a difference in the portfolio returns. But it's like reading different books. It just helps me in that way. Buffett talked about 20 punches and the idea of 20 stocks. 20 stocks for us would represent probably 60-ish, 60, 70% of the portfolio. And frankly, because I've already talked about it, Diageo, well, also it's a Brown-Forman, it's a Pernod. Well, is that 3 positions? Is it 2 positions? Is it 1? It's more than 1, and it's not 3. It's 1.5 or something like that. I own Caterpillar and Deere. Is that 1 position or 2 positions? It's 1.25. It's a fairly concentrated portfolio in that sense, which I think makes sense, and it's appropriate for discipline purposes. I would say, again, in the time in which we live right now, I think the argument for diversification is stronger today than might have been the case 3, 5, 10 years ago. Because people will ask me, what about this, or forecast, and I would say, I can make a forecast, and I would have some boundaries around that I would be, 90% confidence interval that will be between this and that. Well, the amount of things that I have a 90% confidence interval between this and that has diminished. And the other interval that I would say is I can't rule it out. So here's my forecast. But given what I observe taking place, the range of possible outcomes is way, way wider than that. So I want to have some diversification, just like my grandmother happened to catch by accident 2 things that might as well have been selected randomly because she held them for 30 years after my grandfather died that really mattered. And I want to place myself in the way of possibly catching something like that. And over the years, that's been pretty fruitful of just observing something I know a little bit of, and it keeps working and it keeps going up. Why? And follow that trail a little bit, and oftentimes those can become much more substantial investments.
Okay, another question.
Hi, I'm Sten. I work at Baillie Gifford as well. Given the context of where we are and the general sort of sentiment around AI, there's been an increasing rhetoric about viewing AI as a potential bubble, but they've sort of shifted to viewing it as a constructive bubble, and also relating to what you mentioned about the errors of commission. Is it worth pouring all of this money into AI and maybe we're wrong by but it's still beneficial as a society? What's your view on this idea of it being a constructive bubble?
Well, I can give you a very helpful answer. I don't know.
We could move on at that,
Well,
if you like,
but one thing
get
that
some questions.
actually does make some sense of that, you think about the railroads, and so a book I would recommend is The Way We Live Now by Anthony Trollope, and think about the psychology that existed at that time, and just scratch out railroads and write AI every time you hear the word railroads mentioned in that book, and you'll think the book was written yesterday. Now, railroads, a tremendous amount of capital was expended to create them, and a lot of that capital was lost, but we were left with the railroads in the wake of the financial behaviors. And I would say this is a bit of an American idea and an American thought, because I live in America, so I see it firsthand. I suspect there's a bit of this that's applicable in the Scottish ways as well. America's had this unusual marriage between engineers and visionaries and financial scamsters. I get frustrated with it from time to time, but actually it's a beautiful thing societally. And these brilliant engineers who could come up with stuff, they're not charismatic enough, and they don't get people foamed up enough to raise the money to actually make it real and make it happen. The scamsters, they get just enough of the technological development right that kind of gives them cover, and they skim off a lot of money and people lose money and are left, but society writ large benefits. And it seems to me there are many things about our current environment which are evocative of historical things that I've read about in the past, and I have no more precision than that.
Okay, we have a question from Russell here.
Thank you, Peter. I can recommend another book, Engines That Move Markets by Sandy Nairn, which is in this library, and looks at the history of technology investing. So I wanted to ask you about banks. It's always surprised me that value investors, some of the greatest value investors, own banks. So have you owned them? How do you value the assets? First question. Second question, you've been very lucky because you've worked for principals. Now, many of the people in this room are professional managers. They don't have that luxury. They work for agents. Mm-hmm. If you're working for an agent, what tricks could you tell everybody how you can be more like a principal? How do you do that when you're working for agents?
I'll take the second question first. You are correct in that many of us as professional money managers are indeed agents. That's just definitionally true. I think to the best of your ability, you should act like a principal, even though that's true. And just operate that way, communicate that way, demand that sort of respect. You will thin out your clients from doing so, but you'll have better, durable, more important relationships over time. But it'll be a winnowing process to act more as a principal than an agent, number one. So, and it'll be a never-ending battle. Number two, you asked about banks, and Markel historically has been an insurance-based business, even though we've turned into, I don't want to use the C word because people get uncomfortable with that, but owning diversified non-insurance businesses as well has been an important part, much of which we learned from the Berkshire model. So banks, I'll tell you my own personal history. And again, talking to my grandmother and my father, as a kid growing up in the Delaware Valley, the shadow of Philadelphia, there was a bank called the First Pennsylvania Bank, which would be sort of to Philadelphia what the bank in New York was to New York, America's first bank. Philadelphia was pretty close to that. The Bank of New York story has a happier ending. First Pennsylvania Bank in Philadelphia does not. So there was this very charismatic CEO, and he was well known at First Pennsylvania Bank, and this would have been the 70s. Got in trouble, and I think I was in 7th or 8th grade, something like that. And the stock, had been 200, and now it was down to 40 or something like that. And I think I bought 5 shares. That's the most money I had, because I was going to have this turnaround story and this dramatic path to glory as a 7th grader. Well, as you can guess, the way the story goes, it went to 0. So I flamed out on that. And then later on, there was the 7th. I'm trying to remember which one came first. Then there was the Continental Illinois Bank, which was the biggest bank in Chicago, and somehow they got themselves in trouble. And I thought I might have been in college at that particular point in time. So maybe I had enough money to buy 100 shares of that, and it was $2,000, and that went to 0 as well. So that's strike 2 for fans of American baseball. Strike number 3 in banking was First Republic in Texas, with the oil boom coming down and leading bank in Texas, buying some of that. So I managed to maybe have my first job and lose a little more money than that. So I tell people, look, anytime I get this idea to buy a bank stock, I sort of lay down until the fever passes. But I also say I've done it 3 times, and I own some bank stocks now. Not a lot, but some. And Steve teases me. He says, you've done a 180, 540, 720, circling around. They are very difficult to value appropriately. They're subject to risk of ruin through the run of the bank. The insurance mechanism is different. The insurance mechanism is more highly capitalized. There's more equity capital relative to the total size of the balance sheet. And you can withdraw money from a bank just because you want to. To withdraw money from an insurance company, your building had to burn, the car had to be in an accident, life insurance, you had to die. So the money tends to be stickier in insurance companies than banks. So 95% of my work in that world is in the realm of insurance rather than banking. I've clearly proven I'm not an expert in it.
Steve?
Tom, it's Steve Clapham from Behind the Balance Sheet. Forgive me for asking yet another question, but I was just curious what your thoughts were on the Supreme Court currently discussing the tariffs I think the betting is 60% that they'll throw out the tariffs. Can you just talk about what you think will happen? And it seems to me in either outcome, neither outcome is positive. Can you just talk a little bit about your views?
I'll pick up on my early answer, but I have no idea. None. And it's important, but as Buffett would say, the quadrants, there's things that are important and things that are knowable. And I would put that in the category of things that are important, but are completely unknowable. And I can't know them. So I confess that I spend no time even in thinking about it, because I can't do anything about it.
Okay, question in the back.
Hi, my name's Giles Murray. I work for Sculptor Capital, like on the private equity side. If you woke up tomorrow, so hypothetically, you were, 30, 40 years younger, and then you had to kind of start all over again. So you had to, create a mini Berkshire or something similar. Like, how would you structure it? Would you start on the insurance side, public equities, private venture side? Would you want to be public or private? Like, how would it play out if you had a completely clean slate again?
I think I would do many of the same things that I've been fortunate enough to do. And I think the insurance business is the thing to do first, because it's harder and it is more. You need to get that one right first, because that's really where the permanent capital comes from. And again, I don't claim to have a lot of IQ points. I claim to have determination. I claim to be persistent and curious and learning. And the beautiful thing about a well-run insurance company, and me being married as an investor to running the funds of a well-run insurance company, is I've been there 35 years now. That's 120 plus 40. It's 140 quarters. I think of the 140 quarters I've been at Markel, maybe all but one, there was money deposited into the investment account. And it might have been 9/11 that or Hurricane Rita Wilma in 2005, that we might have had a quarter where we didn't have positive cash flow into the investment account. So getting that right and cash flow coming in on a recurring basis, that makes an average or a below average investor look like an above average investor, because it creates the circumstances for dollar cost averaging, which is hugely helpful.
Okay, chat with the Red Sox. Can you tell us your name, please?
Mike Balfour. Tom, thank you very much. You touched on some of your mistakes, but there must have been a great many successes. Is there something you can put your finger on, or a list of things that seem to exist in your great investments? Is it management? Is it cash flow? Is it balance sheet? Is it products? How would you prioritize some of the criteria?
Management, yes. Cash flow, yes. Product, yes. All those things stem from people, though. Somebody had to have the idea, and somebody had to manage that reasonably well. That's where the ideas for the products come from. That's where the competitive moats that Buffett would talk about come from. My father used to say, you can't do a good deal with a bad person. So it is, and again, this is my own bias. I am people-oriented, and my colleagues accuse me of falling head over heels in love with people. And I say, well, you're correct about that, and I do. And part of your job as a colleague is to tell me that I'm wrong. But that works more often than not. And if I don't like somebody, I'm not going to invest in it. And if I like somebody, sometimes I invest in them, and I make the mistake of doing so. You can be seduced by people who you sort of like. But that is an error of commission, and it's self-limiting. But you might get it right. And the things you're right about are so huge relative to the things that you were wrong, that a portfolio over a long period of time really compounds quite well. And the one thing I would add to that, so I have a friend who has been extraordinarily helpful in my thought process over many years, and he is a Buddhist in his belief, and we've had very extensive discussions about this. And he says, liking somebody is a good signal. It's a good signal. Not a perfect signal, but it's a good signal. Not liking somebody is an incredibly powerful signal. And you should trust your gut level instinct. If you just don't like somebody, move on. There's other people.
A question here?
A lot of girls told me that when I was coming up.
Colin Orr. Tom, thank you for your presentation answer so far. The US is dominating global markets in market cap terms. Is that deserved? Are they creating and will they continue to create the great companies that they have done over the last 20, 30 years, or is that something that you think might not continue?
I hope and pray that it does continue. And I think as citizens of the world, obviously as an American I would have some bias, but I think that the world has benefited from Americanization, globalization. There's some synonymic, if that's a word, there's some synonyms between those two terms, the technology that has happened and progress. So I would hope even as Scots, you would root for that to continue to happen because you're better off on account of it. Other places where positive things can happen, as a citizen of the world, I'm rooting for it. But the system and the idea of Western thought that comes from the bottom-up value of an individual that is the cornerstone of Western civilization and Western philosophy, I'm biased. And I think that is a good thing. The systemic spread of what it would mean for individuals when it comes in a top-down way is just different. It's just different. And I don't know how that is going to play out in the way that I would have a high degree of confidence when it comes from a bottom-up way.
Okay, one more question.
Hi, my name's Colin McKinnon. I'm of a similar generation to yourself. My question is, if you were to employ somebody who is in their 20s, like you were, what would you look for in them?
A learner. Somebody who reads, somebody who's curious, somebody who's trying to figure things out, somebody who's willing to admit they don't know. I shudder at my own self in the 20s and stuff I thought I knew and have come to be disabused of over time. But somehow or another, I did always like and get along with older people. So just having some innate respect for that kind of wisdom that goes with age when you're in your 20s, that's a sensation. And so I would look for that as opposed to somebody who did what I was guilty of and that thinking you knew it all.
Great. Well,
I was going to ask one last question. Sorry for the interruption. Thanks very much, Tom, for your insights. Okay, I can be loud enough. Okay, thank you very much. You mentioned a lot about the history, the older generation. What have you observed from the younger generation, especially in regards to the relationship building? Because nowadays, clients, I would say, very different from what they used to be. They probably won't offer in shorter terms. I don't know. What's your insight? Thank you.
Well, yes, the practices are different, and the current ways of communication, whether it's through remote work, through something that's mediated through a form of technology as opposed to a personal one-on-one interaction, I may or may not be right or wrong about this. I will confess to having had a lifetime of practices where the idea of personal relationships and being in a room and sharing the pheromones with people, that matters to me. I might be a dinosaur. I get that. And that's why it's important for me to listen to the 26-year-olds and be curious and observe and incorporate some of those practices and just not be stubborn or stupid. But these are shades of gray kind of issues. And I will continue to learn something at age 63, and I hope the 26-year-olds will continue to learn something as well, and we'll figure it out.
Thank you very much.
Thank you.
great. Well, Markel's annual shareholder letters are always worth reading. In 2006, their letter suggested that there were 3 traits that underpinned Markel's corporate success. They were patience, discipline, and continuous learning. To my mind, no 3 traits better describe Tom's approach to investing. He's not just been a successful investor, he has endured. He has been successful for decades. And on tonight's evidence, he seems to have the energy and enthusiasm for more yet. So I hope this evening has been interesting and given you a flavour for Tom Gayner, the investor, and indeed Tom, the man. If so, please stay for drinks. There are some at the back, as ever provided very kindly by Kennex Asset Management. But finally, I think it's just appropriate to ask everybody to express our appreciation to Tom in the usual way. Thank you. Thank you. Thank you.
Thank you, sir.
Thank you.
So just a housekeeping issue for me. If you could take all your glasses to the back. And one thing, Tom, in 11 years of running this, you're the first person to ever get on the stage and be nice about the Scots-Irish. So thank you. Thank you for that.
Absolutely.
I just want to point out that the Great Whiskey Rebellion was also put down by a Scot called Alexander Hamilton. So anyway, thank you all for coming. Drinks at the back. Please take your glasses. And if you fancy making a donation, there's a QR code at the back as well. Thank you.
Thank you very much. Thanks. Well done. Superb. Great.